On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Talk of a capital gains tax, or a CGT, seems to have found itself back in the headlines here in New Zealand. It first cropped up early this year as part of a Treasury briefing to the incoming Minister of Finance, Nicola Willis. Among other things, in that report, Treasury noted our heavy reliance as a nation on personal taxes, and it pointed to the lack of a comprehensive CGT. Comprehensive is a key word there because we do actually tax capital gains in New Zealand. It's just that we do it on an inconsistent and an ad hoc basis. For example, the bright line test ensures that capital gains are sometimes taxed on residential property, while anyone buying shares with the intention of profit and resale should also be paying tax on those gains. It's hard to see a national-led government following these hints from Treasury. However, it could be back on the agenda when we inevitably see a change of government, with recent headlines suggesting some internal debate within the opposition. CGT proposals haven't gone down particularly well in recent history, at least in a political sense. We saw former Labour leaders Phil Goff and David Cunliffe have a go during the 2011 and 2014 election campaigns without any success. Jacinda Ardern then established a high-powered tax working group when she won the election in 2017, chaired by the late Sir Michael Cullen. That group released a comprehensive report about 18 months later in early 2019, and despite her popularity, even Ardern couldn't sell that to voters. She ended up permanently ruling out a CGT, saying that it wouldn't happen on her watch. However, I don't think we've heard the end of it, and over time, the public might even be getting a little more open-minded about the idea. Ideologically, there is some need for us to take a look at our tax base. Wage and salary earners seem to get whacked more every year as personal income tax rates rise and as inflation means that those higher income brackets kick in earlier and earlier. Meanwhile, you've got untaxed gains from rising asset prices that are one reason for our love affair with residential property investment. That's not the only reason we've got a very expensive housing market, but it is a key one, and that in turn has contributed to rising inequality in many of our social issues. However, I really do worry about the politicians getting it wrong when it comes to the detail and implementation of any CGT or other similar type of tax. The proposal from Ardern's working group was full of inconsistencies. It suggested international shares be taxed in a different way to local stocks and big fund managers be treated differently to smaller investors. The group had clearly spent a lot of time on some things, but it hadn't thought through other issues. There's also an ongoing debate about whether you tax people just once when they sell or whether you tax them more frequently on the way through. The former means delayed revenues for the government. They don't get that money quite as quickly, while the latter means that you're effectively asking people to pay tax on gains that they haven't even realised yet, and that can be difficult. There's also the fact that some assets can also be very difficult to value accurately. Housing is fairly straightforward, and you've always got the council valuations to fall back on, while listed shares and managed funds are priced pretty regularly, if not daily. However, it's much trickier when you start talking about farms and agricultural land, and it's even harder when you start talking about private businesses and their assets. Think of the local hairdressing salon or the panel beating shop or the boat building firm. Very difficult to put accurate values on all of those sorts of entities and the assets that they own. Then you've got artwork, classic cars, antiques, stamp collections. How do you monitor those? Do you include them or do you not? And how do you value them with accuracy and then tax people on those potential gains, realised or unrealised? One thing that is clearer is that any future proposal would almost certainly exclude the family home, as is the case just about everywhere else that has a CGT. That's an understandable compromise, but it does still dilute the impact of a capital gains tax. There would be other allowances too, and as soon as you start doing that, you give those with access to good accountants an opportunity to exploit any loopholes. I really worry about the potential for unintended consequences, which could see asset classes like shares and businesses hit harder than housing and property. That concerns me because I think we need to push capital and savings toward those productive, job creating parts of the economy. Despite all of that, though, I'm still open minded about tax reform, and as a voter, I could potentially support a CGT if it was well constructed and at a modest rate rather than the prevailing personal tax rate. I'd also expect an accompanying reduction in income taxes. For me, that's crucial because for it to be a genuine rebalancing exercise, the tax rate we pay on income would have to come down accordingly. That would really shift the focus towards genuine cash profits and drive investment decisions in the right direction. Otherwise, a CGT would simply be another tax on top of what we're already paying. That raises another bugbear the public will have with any proposal for tax change, which is how our money is being spent. Many high earners, many asset rich voters are not opposed to paying taxes, or being taxed in a different and sometimes less favourable way. However, what they do want is for that capital to be used wisely and effectively. And unfortunately, some poor decisions and some frivolous spending choices in recent years have really dented the credibility of our politicians in that regard. That trust needs to be rebuilt before voters will wholeheartedly embrace a CGT.
For more insights, visit craigsip.com.